with Mother. Thank you very much. We've got the recording going now, so hopefully anybody that isn't able to join us is going to catch up with us after the event, and we'll be sharing this recording through our usual social media channels. This evening's presentation all about freelance and locums and how they can best manage their financial affairs, brought to you by VetU. So VetU is an organization of a number of individuals. You've got Katie, you've got Ebony, you've got Paul and myself. What have we got in common? Well, actually only one thing. We've got MRCVS after our name. We're all veterinary surgeons. And I guess the only other thing probably that we've got in common is that we all have come to personal finance and understanding personal finance in a different way. And that really led us to work together to create VetU, because we realized that in our own individual circumstances, we had been lucky, or in some cases unlucky enough, not to come to good advice as we were going through our career and as we were advancing, we realized that there was a big void in the veterinary industry in terms of providing really great independent financial advice, so that would allow veterinary surgeons and veterinary nurses and all those involved in the profession to better understand how personal finance can be managed and how their personal finances can be managed to better themselves. So we came together to create VetU, all understanding about you and your personal finances. And we really focus on three key areas that we think if you better are able to manage your finances, you will be much more successful. So first is around your health. There are lots of ways of managing your finances to ensure your health is well cared for. We want to make sure that that is underpins all of your personal and professional roles. The second area is around your income. Many of us, and probably everybody here this evening, is receiving an income of some sort, but there may be an occasion when we're unable to earn money, and we all need some sort of regular finance. So making sure that is managed in some way is really important to secure a sustainable future for ourselves. And the last area is making sure that our finance is prepared for the future. What does it mean when we come to retirement? Or what does it mean when we come to one of the life-changing circumstances, getting a family, buying our first house, starting out in business by ourselves, or even just taking that brave step of becoming a locum? So all of those require you to financially plan, and VetU is here to provide completely independent advice. We work with a whole team of experts in this area that can provide you with the very best knowledge and information. And at that point, I'm really excited to introduce our experts for this evening. They are Richard Hepburn and Rebecca, both working for Gorilla Accounting. As you can see, fantastic experience between the two of them. And at this point, instead of me introducing them, I'm going to hand over to Richard and Rebecca so that they can introduce themselves to the audience this evening. Richard.
Hi, Rob. It's great to be here. So just as a brief introduction to Gorilla, we are accountants that specialise in the freelance, locum, contractor consultants market. So anyone really that would class themselves as self-employed, that provides services, that's the sort of client that we deal with and advise on. And our sort of accounting service and advice is geared up to specialise in that area. So we've worked with a lot of locums, from medical doctors, pharmacists, veterinary, but we also work with a lot of soft consultants, IT software engineers, things like that. So yeah, anyone that's working for themselves and doing locum work or contract work, whether they're set up as sole traders or through limited company, we provide tax advice and all the accounting services required. So that's what we do as a company. Myself and Becca have worked together for around 12 years now. Even before we both worked at Gorilla, we've worked in the same sort of area. So we've got quite a bit of experience working with you know, clients like Locums and the self-employed. Just as a bit of an introduction, we're going to go through a few things. We just want to talk through, you know, the difference between working via a limited company and sole trade. Hopefully, if anyone's looking to move into locum work, it should sort of, you know, ease any fears if you're thinking it might be a bit too difficult to get into, or, you know, a bit worried about owning your own business. We can obviously answer any questions on that. Answer some of the common things we get asked about expenses, VAT registration, and we've also got a number of questions that we're going to answer as well that we've picked up already that are really good, fit into to our advice, like IR35. So yeah, we'll start off, I think, going with the limited versus sole trader route. Do you want me to take this one, Becca? Or
yeah, that's fine. Carry on.
Yeah, and Richard, we've got a relatively small audience this evening, but that's not to say that we always know that these episodes get well picked up afterwards in our 2,000 plus followers. So we will be making this available more as an instructional type of webinar for future people to view. So feel free to go through some of the basics in detail, because we know that our audience will be benefiting from that.
Yeah, excellent. I think it's good to start off with the limited company versus sole trader route, because anyone that's looking to maybe start picking up some locum shifts or move over to being a locum, they maybe don't know where to start, which is the best way to go. So it's good to have a look at the two options. So we'll start off with being a sole trader. So that's basically working for yourself without having a company involved. You would still have your own business, but the business would be in your own name. You would still need to complete a self-assessment, which I'll come back to later. But the taxation is a little bit different with that. There's a little bit less sort of filing requirements and responsibility with the sole trader route, so some people prefer that. But you are required to report your income each year on a self-assessment. So with the sole trader option, you would basically invoice for your services, and any income will be attributable to you. So you get paid any income in a given tax year, which is from the 6th of April one year to the 5th of April the next year. And your taxable profits are basically what you pay tax on. So how that is calculated is your income minus any expenses, gives you allowable expenses, that is, gives you your taxable profit, and you will pay income tax on that, which is either at 20% of the basic rate, 40% higher rate, and you know, if you're lucky enough to be an additional taxpayer, that is up to 45%, but that's soon to be abolished from next year. So yeah, that's how that works. In addition to that, you pay national insurance contributions, class 2 and class 4, and you also have your personal allowance, which is at the moment £12,570, where you won't pay any tax at all. So that's how you're taxed on being a sole trader. We'll come on to expenses in a little while, but I'd say that the expenses do overlap quite a lot between being a sole trader and a limited company. A lot of the expenses that you could claim are very, very much the same. There's a few little differences, but things like traveling to client sites or customer sites where you're going to be working, if it's temporary workplace, then you can claim for those costs. So we'll cover a bit more on expenses later, but the relevant ones are very similar. Looking at limited company, the option of limited company, the main sort of reason people go down this route is because potentially you can pay less tax. And a factor in this is IR35. So we will go into that in more detail later on, but I'll tell you how it's relevant here with the limited company. So I think the first thing to mention is there are more sort of responsibilities and requirements with limited company. A limited company, so not only will you still need to do a self-assessment tax return as a shareholder with the company and the director, there is filing responsibilities for the company. So annual accounts, corporation tax return. If you're VAT registered, either as sole trader or limited company, to be fair, the VAT returns need to be done quarterly, and potentially payroll as well. And I'd say that's one of the main reasons you probably do need an accountant if you're going for the limited company route. We'd probably advise having one as a sole trader, but it's definitely more important for the limited company, because things like annual accounts that need filing each year, payroll for your company. And the reason that is because it works out a more tax efficient way in most cases to work for the limited company, because you can set the salary at a level that you want. So essentially what you can do in most cases is have a salary up to the personal allowance or the NI threshold, whichever works out better, and effectively you wouldn't pay any national insurance on the salary. At that point, you can pay yourself dividends from the company, which are paid after corporation tax, which is 19%. But the tax rate on dividends are a lot lower than they are on either salary or sole trade income. So we're looking at currently, that is 8.75% at the moment in the basic rate, which is compared to 20% as a salary or sole trader income. So it's a lower rate of income tax, and you don't pay the national insurance. So they're the main reasons. I did touch on IR35 because it really does affect how you pay yourself, because if you're inside IR35, which we'll go into in a little bit more detail later, then you don't have that flexibility of choosing your own salary. What they're saying is, look, for tax purposes, we've deemed that the way that you work is the same as an employee, so you should be taxed the same as an employee. So all the income coming in needs to be processed as a salary, and it really sort of, it takes away the benefit of operating through a limited company. So a lot of the locums that have been set up that way, they will sort of be aware of this or come across this, and people coming into the locum world should also be aware of that. So yeah, the pros and cons of going either way, and sometimes we actually see that some of our clients, their end client that they're working with, ask them to be set up one way or another, either as a sole trader or a limited company. So that's another sort of thing to think about. And in some cases, if the engagement is inside IR35, the best way to go is just through an umbrella company where they process the salary each month, because the tax saving of operating as a limited company is really taken away in that case. We will go into IR35 a little bit more further down the line, but I think that pretty much summarises the two options that you can go with when working as self-employed or a freelancer or a locum, the sole trader or limited company route.
Richard, can I ask a question at this point? Is there any advantage? One of the big questions always with vets, especially locum vets, is around vehicles and running a car. Is there one route or other that's more appropriate if you want to be able to run your own vehicle?
Yeah, so again, it's slightly different with a limited company and sole trader, so it is a good question. But if you own the car personally and you're doing business miles, so if you're going to what we would say like a client site, and it's a temporary workplace, just to explain what a temporary workplace is, it's somewhere that you don't expect to be working for more than 24 months, or you're only spending 40% of your time there. So if you're doing shifts at different places, that can always be seen as a temporary workplace. Either way, if you own the vehicle personally, you can claim mileage, which is 45 pence per mile up to the first 10,000. Or if you have a limited company, you can then have and you're an employee, you can have a company car, and you work out the benefit in kind on that car. So it usually works out better to have the car personally rather than the company pay for it and claim the mileage, but it does really vary. because the benefit in kind is basically a percentage of the list price of the car worked out on the fuel emissions. So if you've got a car with high fuel emissions, then it's really not worth buying it through the company. It's better to have it personally. But if you're looking at, say, an electric car, there's an argument to say it might be better to do it through the company. And just to confuse things more, if you are a sole trader, you can still go with the mileage, but you can also, there's another way of working it out where you basically say, let's say, for example, your business use of the car is 50%, personal use is 50%. You pay for basically 50% of all the costs through the business. There's a tax expense, and the rest you pay personally. So that's one of the differences between the sole trader. But what we usually see is the mileage is the better option. Pay for the cost of the vehicle yourself, and any business miles you claim, and you reclaim those from the company, or it goes as a sort of tax deductible expense.
Okay, thank you.
I'll say probably just on that, it might be worth touching on expenses, Becca.
Yeah.
Yeah.
So as Richard said, expenses for sole traders and expenses for limited companies, they're going to be the same thing, because it's whatever expenses you've kind of incurred as part of your work. So anything allowable is anything that you need to pay for to do your job, basically. The sort of words that HMRC would use is wholly, exclusively, and necessary. So like Richard mentioned, there's mileage to get to your temporary workplace, or travel, however that might be. If it's public transport or whatever it might be, you can claim that as well. The main things we would see from locums are insurances, scrubs and uniforms and things like that, any safety equipment you might need to purchase. Anything subscription wise that you might need to pay for to carry on as a vet, that can be put through as well, and that applies as a sole trader or through a limited company. The one big difference in the sort of expense that you could claim through a limited company, I suppose, I mean, it's never ending the list of expenses. I suppose it depends what you incur, but if you are through a limited company, you can pay yourself a salary, and that is an allowable expense. So that gets deducted from the turnover of the company before you pay tax on that. So the difference there being, all money when you're a sole trader is taxed as the income you've received, whereas through a limited company, you have that turnover, you take off the expenses, and the salary that you're paying yourself can be included as one of them expenses.
Great, thank you, Rebecca. So does that mean with a limited company, we may be able to defer some tax? Is that right? Because we can take a salary that we need money as we go along, whereas obviously with a sole trader or partnership, we're going to be taxed on everything.
It's like we recommend a sort of what we refer to as a tax efficient salary. So it's worth taking a salary up to a certain level, but so that then you get your things like your pension, your qualifying year for state pension and things like that. But not taking too high of a salary, and instead, as Richard touched on before, topping it up with dividends, so that you are making the most of the lower rate of corporation tax versus that rate of personal tax if you were a sole trader.
Okay, so if you were a locum and expecting, for example, your income to be inconsistent, one year very, very high and another year quite low, maybe in the third year back to being high again, which structure would you recommend, do you think is going to be the most tax efficient?
If it's going to be high at any point, it's probably going to be worth setting up a limited company, because whatever turnover you get and any money that's generated and stays as profit, if you don't take it as dividends, it sits there in the business for you to utilize at any point going forward. And it's not going to get taxed again for corporation tax. It will only get taxed again as personal tax once it's taken as those dividends. So for consistency, you could then sort of set aside the money to pay yourself in that year where you didn't have as much income.
Great.
It's a good point. I mean, the dividends, you can leave some of the profit. So the dividends are paid from the profit in the company. And, if you wanted a break one year and you weren't sort of doing as many shifts, this is some profit to carry forward. You can pay yourself that in a future year. So it's a bit more flexible how you receive the money. It's a bit more flexible with tax planning. So you can structure it so you pay yourself a certain amount without going into the high rate tax bracket, and leave some funds in the company for dividends. And there are some other ways you can sort of go about things. So you can have your company you have shares in the company, so it's possible to have that set up with another shareholder. You can give shares if it's a spouse. So if you're looking at it as a family and you're married, then there's ways that you can sort of have your company set up so that you can own the shares in the company and both receive that dividend income as well. So if you're looking at it from that point of view, there are some tax savings to be made by setting up that way.
Now, I know that historically, maybe a limited company had an overall lower tax draw on profits, but in recent years, the Exchequer has tried to narrow that gap between how directors of a company may pay themselves through dividends to try and make it more fair with sole traders or partners. Has the current or the future changes that the Chancellor has just announced made any difference to those levels of taxation?
It's the same, to be honest, because what they've actually done is they've reduced, they increased national insurance,
okay,
which employees, employers, sole traders pay, but people receiving dividend income don't. But they've also, at the same rate, increased the dividend tax rate by 1.25%. So whichever way you go, that's increased. They've now announced that's going to be scrapped, but from next year. So in recent times, it's not made much difference. It's still better in most cases, but not always, to be a limited company. The other recent announcements was the cancellation of the increase in corporation tax that was due in 2023. So it was due to go up to 25% for some businesses, and that's staying at 19%. So that makes a big difference for the limited company. That would have that change actually may have made the sole trader option in a lot of cases the better option. It's one of them. It all depends on the income, because even with the changes that were due to go ahead, which they're not now, there was still sort of a lower rate for the smaller businesses with profits of 50,000 or less, which a lot of self-employed would fall into that bracket. So again, it's not always a clear-cut answer. I think that's the thing. And yes, it isn't as sort of the tax is higher than it was years ago. I mean, we can both remember when there was no tax on dividends in the basic rate. That's gone now. It's a lower rate, but I think the good days are over where there's huge tax savings. But it's still better. It's still better in most cases with a limited company.
So, Rebecca, I know you've been speaking to pharmacists and landlords, and unfortunately, you've just got the lowly veterinary audience this evening. So actually, working out what we can put through as expenses can actually make a material difference to our take-home pay. I just wondered whether you can provide some guidance about how far what we can push through our expenses, what's likely to be acceptable and what isn't. So, for example, would my new Prada Wellington boots at £500 be acceptable, or do I have to stay with a pair of Nora Wellington boots or Dunlop boots at 50 quid? And how much, for example, of my clothing can I put through as an allowable expense as a veterinary surgeon?
Yeah, it's a good question. And it sort of boils down to, it depends who you're working for and what you're turning over, really. If you've got some really high class clients who expect you to be kitted out in the absolute best Wellington boots that you can get from Prada, then you've got a case to argue that you need them. But I think in most instances, the wholly exclusively and that important word necessary comes into play when it comes to like how much you're spending on these certain things. For the most part with clothing, HMRC do stipulate that it should be protective clothing, or if you have a company, it should be branded with your own logo. So you couldn't just, not really specific to vets, but say you needed a suit for an awards ceremony, that wouldn't be allowable, because obviously there's a personal element to that as well. But yeah, it's more or less, when it comes to vets, I know that you have to spend money on scrubs or specific shoes or PPE and things like that. And all of that would be absolutely fine in either the sole trader or the limited company route.
Great. So I need to set up Jimmy Choo Vets.
Yeah,
Then
absolutely.
I can justify those high heels I've always been after. Fantastic. And so the same question really goes around subscriptions is another big area. Vets are members of many societies. We have our professional subscriptions to the Royal College. We probably have indemnity insurance and things like that. How many of these are allowable? Can I sneak my Netflix subscription through as well? And how many aren't allowable?
Yeah, the majority are allowable, I would say. Again, the subscriptions that you need in order to practice being a vet, they would be absolutely fine. If you need, we do have people who try and put things like Netflix subscriptions through, and their argument can be that they need to watch a certain program or film. If you think you can justify it, then on your head be it. But for the most part, I'd be suggesting it's more things that you absolutely need to be running your business, be it sole trader or limited.
Okay.
Yeah.
And sort of associated with that, I always remember as an employee, health insurance suddenly became a P11D benefit. Yeah. But if I'm a sole trader, locum, freelancer, can I put health insurance through as a business benefit?
If it was through a limited company, it would be classed as a benefit in kind and go on that P11D.
Okay.
From a sole trader point of view, I feel like it would be the same. Richard, you might be more.
Yeah, it's still taxable. Taxable. It's one of those things. Basically, what they're saying is, if if you would be paying for that personally, then it's not going to be an allowable cost. It's the same thing. It goes on the tax return.
Is the same go for things like life insurance policies, or the other big one with locums is some form of income protection policy? Many locum vets might get bitten by a dog or scratched by a cat or kicked by a cow and want to take up income protection policy. Is that an allowable expense?
Yes. So but there's different policies. That's the key thing here.
Okay.
So this is relevant life is a life insurance policy that a limited company can take out, and it's a bit like a death in service sort of policy. So as an employee of the limited company, the relevant life policy would be fully tax deductible for the company, and there'd be no tax on the payer as well. So it's really that's a good setup one. So that's basically the company can provide that to their employees. So that's that one. But if it's a normal life insurance policy, a regular one, then no, it's you might as well pay for that yourself. With the income protection, there's two different ones really. So and again, we see this a bit more with the limited company. So I don't think it quite applies for the sole trader, but I need to have a look at that. But for the limited company, the income protection, it can either be tax liable or not, and it depends on who the beneficiary is. So the company can take out the policy in the company name, and if there's a claim, the company receives the income. So there's no you get the full tax relief on the cost of the policy, but if you receive the income, then that's taxable income, and then it needs to be paid to you from the company, and you pay personal tax on it. So there's no tax on the payment, but when you do receive the income from it, you pay tax. The other one is like a personal policy, which is not taxable deducted from the company because basically the beneficiary is the person. So what happens is the taxman says, you need to pay for that personally, or it's a benefit in kind from the company, because when you receive that money, there'll be no tax to pay on it. So it's kind of like choosing, do you want to pay the tax now or later? So it depends on the policy, is the answer. But yeah, the income protection one, if it's in the company name, then yeah, it's fully tax deductible and the money is received to the company. But if you get that money, then you pay tax on it when you receive it from the company.
Sounds like a trip to the bookies. You either pay tax on your stake or you pay tax on your winnings. Just depends on how lucky you're feeling you're going to be. And I guess that's a bit like that with life insurance, isn't it? How lucky do you think you're going to be? No, that's really good advice. And actually, all your answers are telling me this evening that, however long in the tooth like me you think you are, you still need some great professionals giving you advice around some of these professional matters. So that's great to hear. My next question really is around pension contributions, and a lot of locums and freelancers will be looking to the future to save for their future. Any different benefits to paying pension contributions individually or through a limited company or as a freelancer?
Yeah, so if you pay, you can pay pension contributions personally up to it's 80% of the salary that you're receiving. And that will extend your basic rate tax band. So basically, the amount that you put into a pension can extend your basic rate tax band and mean you will pay less tax potentially in that higher rate if you are going to be a higher rate taxpayer. What you can do, you get an allowance of 40,000 a year. If you have a pension pot set up already, then you can utilise any brought forward allowances that you've not used, going back for the previous 3 years. And if you have a limited company, you can make employer contributions to a pension. Now, they don't get grossed up like personal ones do. By that, I mean, you pay into the pension and the government will give you the extra 20% to go towards it. But through the employer contributions through a company, they're paid in and they just sit there at whatever they've been paid in at. But they are allowable for corporation tax relief from your limited company. So they're another allowable expense like we were talking about before. Okay,
great. Well, listen, for the last 5 minutes of our presentation this evening, I've got a few quick fire questions and some of them are repeats, so excuse me for that. But hopefully you can give me a 30-second answer to each of these. So for the purposes of our audience that are watching this on repeat, as they say with the BBC, give us your 30-second highlight around the recent IR35 reforms.
Yeah, so this has been big news, I'm sure, for a lot of locums, and definitely in the sort of industry we work in. And I'm not sure if you know, but it was changed in 2017 for public sector, and then I think 2021 for anyone working with engaging with a large company. And basically, the responsibility was moved from the worker or the locum, the contractor, to the end client to basically establish if they're seen as inside or outside IR35. And now it's being moved back to how it used to be, where the worker is responsible for determining that. And just so you know, it's for tax purposes only, but it's based on the way that you work, your working practices, whether you are seen as an employee or not an employee, a separate entity, just there to work. And the if you don't know what IR35 is, it's 3 things that are looked at: direction and control. Do you work in your own way, deliver the work yourself, rather than an employee-employer relationship where someone tells you how to work and how to do that? Right of substitution. So, for example, using locums, if one day you couldn't work, another suitably qualified locum could do the job and come in and do that. That's another reason to say, well, yeah, I'm actually outside. And one's called mutuality of obligation, which means at the end of the term, there's no obligation for the company that you're working for to provide further work, or you to continue providing them with further work once you've done your contracted or agreed term. Then an employee-employer relationship, they should be giving you continuous work. So my view on that, a lot of locums should really be outside IR35, but with the regulations that have recently been put in, the hands have been tied a little bit with how that's determined, and hopefully this should be a bit positive news.
Great, thank you, Richard. So my next quick question: I'm a non-UK national. Does anything change with regard to the locum finances that we've discussed this evening?
No. So basically, like I said, we can only advise on UK tax law, but if you're working here, everything still applies to that. And yeah, so if you're here as a UK taxpayer, which you would be if you're in the country and working, then all that applies. So yeah, if you're coming over here and looking to work and we do see that quite a lot. I'm sure that you guys do, that locums will come over, and also we see sometimes they'll go and work in different countries as well. So we have quite a few clients who are set up with limited companies, and they might go and work in another country for 6 months, keep the company and come back and work here. But while you're working here, you're required to pay UK tax on your income. And if you've got a UK limited company, you pay corporation tax on that as well. So, yeah.
And Richard, so if you're working in different countries, how do you decide which you should be paying tax in, or should you be paying tax in all of them?
So the good news, well, the good news is, it can be quite complicated. However, the good news is you shouldn't pay tax twice. So most countries have a double taxation agreement. You might be required to do a tax return in both countries, but if you've already paid tax in one country, it's then added onto the tax return in the other as tax paid. So, you know, if you're, so you might, if you, let's say you work in the UK for, you know, 6 months, and also in another country for 6 months, you might actually be a tax resident in both countries. So we're required to do a tax return in both countries, but you usually pay tax at the country where of the source of the income first. So it can be a little tricky, and you probably need tax advice in the other country that you're working at, but you shouldn't actually pay tax, you know, basically double tax from the income.
Okay.
So,
and is that something that Gorilla can help with if I happen to be employed in more than one country?
Yes, so we can help with the UK tax return, but we can't help with the tax return in the country. We can only advise on UK tax law. But if you've got income from another country, we can include that in your UK self-assessment and apply the law. So if you pay tax there, we will add that as tax paid onto your UK tax return. So like I said, you're not paying tax twice.
Now, I know I have to be VAT registered once my income reaches a certain level or my turnover reaches a certain level. Any advantages in becoming registered for VAT before that threshold?
Yep. There's a couple of advantages to being VAT registered. If you are registered for VAT on the standard rate VAT scheme, you can reclaim the VAT on any of your expenses that incur it. It's hit and miss whether there's going to be loads and loads. You see more VAT applied to sort of labourer work and things like that when they're buying lots of products, whereas probably the majority of your subscriptions and things won't have VAT applied. But some of your uniform requirements or PPE or parking, or if you were buying meals and things like that, and accountancy fees, mobile phone bills, things like that, they'll have VAT applied to them. So if you're on the standard rate VAT scheme, you'll charge VAT to your end client at 20%, and you'll pay it over to HMRC at that 20%, but less the VAT reclaimed on any expenses. There is another scheme that you could go on to called the flat rate VAT scheme. It's less favourable now than it used to be for people who are kind of in the sole trader or sort of single person limited company. But it basically means that you charge the VAT at 20% to your end client, and then you pay it over to HMRC at slightly less than you've charged it. It's to minimise the amount of administration you need to do, because you don't have to include any paperwork for expenses and things like that onto the software for your accountant necessarily. And it means that you just submit the figures to HMRC, and as I say, you get that small advantage of paying over slightly less VAT than you have charged.
Great, thank you. And my, unless we've got any questions from the audience that are with us this evening, my last question for the evening is, I find accounting and bookkeeping just such a pain in the backside. I just forget to submit my receipts, and the deadlines always come around in a hurry. Any suggestions on how I can make this less of a drag?
Yeah, we'd say get some bookkeeping software. And this is particularly important because NTD, I don't know if we've not touched on NTD, but that's another topic. But from 2024, any self-employed person with turnover of over £10,000 will be required to do NTD filings, and you need a sort of compatible software to do that. So
that's making tax digital, is it?
That's right. Yeah. And if you're VAT registered, there's already a requirement to do that with the compatible software. But also we use something called Free Agent, and it's great. You know, your bank account can link up to it, so any expense payments that you do will already automatically pull through to the software. You get an app, so you take a picture of your receipts. So you don't need to keep all your receipts, and it links up to the transaction. The VAT returns are done through there, so you've got all your information there. We can access it remotely because, you know, we work with our customers up and down the country, so we can review everything as accountants. But even if you just set up yourself as a record keeping, I think the days of keeping bags of receipts and, you know, trying to scramble at the end of the tax year to get everything together are gone. So we recommend Free Agent, and
not in my household.
Yeah, well, it's that's our advice on that. Get some good bookkeeping software. There's lots out there, but we find Free Agent the most easy to use, and you know, we provide it for any of our clients, but you can buy it yourself if you're looking to do things yourself. And yeah, it's great.
Great. Listen, that's great advice. Get some good software and get some good accountancy advice. And I think that's a great way to finish. So I just wanted to finish by talking through some of tonight's take-home messages and calls to action. If we didn't answer your questions this evening, please feel free to ask them via social media or make contact through the usual channels on VetU, through the VetU website. Please sign up. The whole team are here to answer your questions or to signpost you to somebody that can help you make better decisions around your personal finances. The email address, hello@vetu.co.uk, always somebody answering that. There's lots more events that we have coming up over this autumn and winter schedule. So please look out for those via the usual social media forms to sign up. Most importantly, tonight has all been about locum financing, and we've been very privileged to have the team at Gorilla, Rebecca and Richard, giving us their advice. What's even better is they are offering for VetU members 2 months free accounting, which, you know, really will allow you to get your accounting affairs under control using their advice, allowing you to move into 2023 under control and understanding your finances in a better way. And I certainly know that a member of the VetU team is using Gorilla to great success. So thank you to Gorilla for joining us this evening. We definitely feel we've had a number of VetU members join Gorilla and take up their services. So we're really excited to be partnering and working with them for the future. So that's it. Thank you so much for joining us. If you've got any other questions, please shout them out. I'm just seeing there's a couple more things in the chat. No, it's just contacts, the hello@vetu email in the chat room, and the link to all our futures events. So for the exclusive audience joining us live this evening, thank you for giving up your time. Thanks again to Richard and Rebecca, and thanks to Jen, who behind the scenes has helped me host this evening's webinar. For those of you that are watching on catch up, please feel free to reach out directly to us at VetU or straight to the team at Gorilla. They are there, educated and informed all about the veterinary industry and specifically about locum vets, and they can provide you with what we know is some of the best advice to make sure your financial affairs are in order for the future. So thank you for joining us, everybody, and we will see you again on one of these channels very shortly. Thank you.